So first of all, everyone, welcome. Glad you could join us today. My name is Elizabeth Kelly. I am your host for the webinar. I've been a real estate investor for the last 17 years. I'm also a coach and a multifamily and rent-to-own specialist. And super excited to have Bob join us. Bob has been an accountant in my network for, I guess, a couple of years now, Bob?
For sure.
One of the things I love the most about Bob is that he's not someone who is just focused on real estate. He is someone who is focused on supporting entrepreneurs. And I'm sure all of you know, we have a very different mindset. We look at the world differently. We have a different perspective. We have different goals. A lot of us in real estate, we might start as wanting to own a property or a couple of properties. But as we grow, we typically want to start creating multiple streams of wealth. And Bob's a fantastic accountant in terms of being able to grow with us, because when we have a vision for an interior design company, or we have a vision for a construction company, or whatever else is part of our vision, Bob's firm is very uniquely positioned in order to help us grow. So we're really excited to have you here today, Bob. Good afternoon, VJ. And I'll just do the quick little housekeeping items. So just a reminder to everybody, on the right-hand side of your screen or wherever your chat box is, there's a drop down at the bottom. Make sure you click it to everyone, because for some reason, when you enter Zoom, it defaults to hosts and panelists. So if you only send your message to hosts and panelists, then Bob and I are the only ones who see it. So click your drop down in the chat box to everyone. And if you have specific questions you'd like Bob to answer during the Q&A period, please make sure you put them in the Q&A tab, because otherwise they'll get lost in the chat, because Bob's a veteran presenter and I'm sure he'll ask you guys questions and it'll be interactive for sure. And I think that's basically everything I kind of needed to cover. Let me just take a quick look here. Yep, that was pretty much everything. Bob, it is over to you. So excited to have you join us. Thanks for sharing your knowledge and expertise on cash flow management. I'm super excited for this one.
Absolutely. All right, let's share this. And then Elizabeth, just give me a thumbs up that we're good to go, that looks good on your end. Guys, so excited to be here. Always love my collaboration time with Elizabeth. She brings so much value to the table, to her community, and certainly happy to support in any way that we certainly can. So we are going to talk about cash flow management today and how to prepare for growth. A little bit of a background on us. I think Elizabeth did a good job giving an introductory to us. We are an accounting firm. We actually have a law firm in here as well. So we've added legal services. We really only provide accounting, tax, legal services for business owners and investors, right? Obviously, I feel like anyone who's got investment in real estate, that's a business. Whether or not it's considered investment income or not, it's still a business, and it's a venture that we're interested in pursuing. A couple interesting, maybe little tidbits for us. We are recognized by the Globe and Mail as one of the fastest growing companies in Canada, which is really, really exciting. And in 2022, when the rankings come out this year, we're going to skyrocket up those scales as well. So we're really excited and proud about that. I'm a regular contributor to Entrepreneur Magazine and Forbes Magazine. So we are, considered an expert in our space. As far as the real estate side goes, I also do have an active portfolio of about $30 million in real estate as well. So not only do we talk and help others, plan for and execute on their real estate initiatives and investments, but we do it ourselves as well. So which is great, because we've failed and we've succeeded, and we can share all of those around the board. So my team is just shy of 50 professionals. Again, the legal services side has been a really great addition for us, because any of the business owners that we work with tend to have real estate investments or other strategic initiatives. So now our legal team can help support those individuals with buying and selling, coming up with the appropriate contracts, partnership agreements, shareholder agreements. So we've got essentially a full list of services focused specifically on business owners. But that's enough about me. Really excited to share with you guys some insights on cash flow. So I'm going to start diving into that, I'm going to jump in a little bit deep on cash flow, and then we're going to talk about growth and opportunities for scaling either your investments or your business, or both. Okay, let's start out with a really scary statistic. 82% of businesses that fail because they run out of cash resources. All of us have been there where we've got a whole bunch of equity in some position in our lives, whether it's in our real estate, in our business, in our principal residence, but cash flow has been super tight. So what this is ultimately saying is those businesses that don't succeed, really the majority of the reason they fail is because they run out of cash resources. Not saying that their business isn't a great idea, or that they don't have a great team, or that they don't have a great product, or that they aren't the smartest people in the room, but they run out of cash resources. So to take away from this, what we really want to do is make sure that we never run out of cash. And that's what we're going to talk about today. So what happens when we start to get a little bit of a tight feel on cash flow, whether it's inside our investments, inside our business, inside our life? We start to get a little frustrated, right? The very first thing when we start to have to transfer from account to account. I should say there's another statistic out there. 92% of business owners in North America live paycheck to paycheck. 92%, which is terrifying. Meaning that if you've got payroll, if you've got property taxes, if you've got any of your bills, you're transferring monies from one account to another to make sure that you're covering it on a weekly basis, right? That gets frustrating. And then all of a sudden, a lot of your time is consumed by just bouncing around because our cash resources are tight. It also starts to give you a little bit of doubt and uncertainty, right? If we are going to continue to have to deal with this every single week, at some point, likely we're going to miss a payment, or we're going to fall short on our cash. And uncertainty starts to give us doubt and stops us from thinking big. It stops us from thinking growth and future investment, and more so about how do we continue to survive. When we have uncertainty, we start to panic. Now, when we start panicking, we start making bad decisions. Panic causes abrupt decisions almost out of scarcity, right? We're just trying to survive. And then once we're panicking, we get a little bit desperate. We've all been there where we've maybe maxed out our credit cards, or we've used some higher interest loans because that's the only thing we can think of in short term to help continue to satisfy our cash needs. So a little bit challenging there. And then once we start making these bad decisions, potentially higher interest rates, short-term repayment periods, it puts a lot of strain on our business, on our investments. And ultimately, that's where 82% of the businesses fail, right? We call this the downward spiral related to cash management. And what we want to do is come up with a strategy to make sure that this sequence does not happen to us. And that's what I want to share with you guys. So before we start talking about tricks and tactics on how we can improve our cash flow, what we need to understand is what is actually impacting cash inside our business, in our lives, in our investments. We need to understand how this works. So what happens when we have accounts receivable, right? We think of accounts receivable, if we're thinking of investment property, that's when we have rent that should have come in at the start of the month, but we didn't receive it, right? It's great. It looks like we're making income. We hit the start of the month. The first day of the month in any sort of investment income is always going to be the best because we haven't incurred all the expenses related to it for the entire month. But the first day, all of our rental income comes in. But if we don't actually receive the cash and we don't deposit it into our bank account, that will impact our cash resources. So we need to be aware of that. So one of the strategies is going to be, let's go after the low-hanging fruit. Anybody who owes us money, we need to go in there and get it. The longer we wait, the more susceptible we are to loss on not receiving that in the future. Inventory. So if we've got, again, in the rental side, if we're thinking of inventory being units that aren't rented, right? If we've got units that aren't rented, we're paying cash resources in order to continue to keep them ready, but we're not getting anything coming in on the opposite side. So we want to make sure that if we do have units available, that we get them active and we get them earning us rental income. Accounts payable. So accounts payable are an interesting one. When accounts payable go up, it means that we've incurred expenses, but we haven't paid them. This is going to be one of the cash management strategies that we're going to talk about as well, because managing accounts payable can actually have a huge impact on our cash resources. One of the things that we need to consider is if we pay our bills the moment we receive them, that's actually going to have a negative impact on our cash, because as soon as the bills come in, we're outflowing cash money. We may need to consider a different strategy related to that. Increase in taxes payable. I'm going to do a whole section on taxes because I can't help myself, Elizabeth. Sorry about that. But one of the major outflows that we have in our business, in our investments, is taxes, and we need to understand how to mitigate those. Loan financing received and loan payments made, right? So one of the ways that we're going to be able to impact cash flow is to have access to working capital, access to cash resources. We're going to talk about that a little bit as well. But if we also think the other way, we may have a profitable business, but our cash may be negative because we've got such large loan payments. So we have to be paying attention and conscious of those as well. This is a big one. We see this all the time. When we go in for our annual performance reviews, when we talk to many of our clients, we work with, I'm going to say 800 corporations and investments specialists. And one of the things that happens at the end of the year, the business owner or the investor comes in and says, Bob, you said I made $200,000. Yes, you did make $200,000. Well, where did it go? Because there's nothing left in the bank account, right? And these are all being impacted. Are all impacting our cash flow. But one of the largest ones that people don't pay attention to is the fact that they continue seeds on the sale of assets. So looking at whether it's an investment property, maybe we sell the investment property and we're getting cash resources related to it. That could be a really great income of cash flow. But if we're also investing and we're buying more property on the other side, we have to be conscious of the fact that cash resources will be going out the other way. So we just want to pay attention to those as well. Cash sales, if there's things in the investment property in our business, one of the things when COVID came up, initially we talked to business owners and we said, one of the greatest ways that you're going to be able to get access to cash now is liquidate your inventory that hasn't been overly productive, discount it, get rid of it, and get cash in your pocket. The other way to think of it is to think of maybe equipment or machinery or furniture, fixtures that aren't being utilized. Let's sell it. Yes, we might only get 10 cents on the dollar for it, but one, we're going to alleviate some of the cash to be able to put that back in our business. And two, we're going to get rid of stuff that's probably just sitting around depreciating and becoming less and less valuable anyway. So we might as well put that cash back in our business. Increase in deposits on hand, deferred revenue. So this one is a big one. If we're thinking first and last on an investment property, there's still so many landlords who don't take a first and last payment. Get those payments up front. It will boost your cash resources that you have available, right? And it limits your risk and exposure for those tenants if they don't pay at one point, that at least you're getting the opportunity to recover that rent from their deposit on hand. Decrease in prepaid expenses. So prepaid expenses mean that we're going to pay for something and get the benefit of it later on. This is something that we want to try and avoid as much as possible. In fact, the strategy is more so we want to get access to the benefit of it and pay for it later. But we're going to talk about that in a minute. Okay, so now that we've seen the impact that some of these areas will have on cash resources, what I want to talk about here is how we can accelerate some of that cash coming in. Okay, here's a good one. Accept multiple forms of payment. So often for any business or investment, when we want people to pay us, we're saying it's got to be cash or check. let's stop that process immediately, right? Let's make it easy for people to pay us. Let's accept credit card if we need to. Yes, it might be 3% more, but we're getting access to that cash. We're going to be able to charge it every single month. Increase the rent by 3% to recover it if we need to. But what we want to have is access to that cash and the ability to make sure that our cash is predictable coming in. Accepting pre-authorized debit. EFT Canada is a really great program. If anybody, we used to use it, but we moved on to a different platform, but it's very economical. If you wanted to set all your tenants up with direct deposit information where you get direct deposit info, that's a really great resource. I'm sure there's a ton of resources out there. That's just one that I know that I've used and have felt really good about it. That's going to allow you to pull that rental income, not wait for a check, not wait for cash or a manual delivery. Let's accept all forms of payment. Set yourself up with online banking so that you can accept online banking payments, EFTs or e-transfers as well. Let's make sure that we're accepting all forms of payment so that we're not just sitting there waiting for somebody who only has one means to pay, which is going to be a bank or a check, right? So credit card, online payments, cash, checks, e-transfers, whatever it is, let's start accepting it. Let's start looking at collecting money at the time of sale in sort of an investment environment. This would mean let's make sure that we are getting that first and last. Let's make sure that we are actively collecting on the first of the month. Let's make sure that people aren't occupying our space without getting paid, because the longer we let them away with it, the more they're going to take advantage of it. So we want to make sure that we're getting that cash up front, because again, if we have to start chasing people and it becomes an accounts receivable, it is negatively impacting our cash flow. Property taxes are still going to be due. Mortgage payments are still going to be due. We can't really postpone these, although a lot of people do postpone their property tax payments. I don't encourage that, but it does happen. But let's make sure that we are getting that cash inflow. So the longer an accounts receivable stays outstanding, the less likely it is that we're going to be able to collect it. So if it gets beyond 30 days or 60 days, you've definitely got a tenant issue inside your investment property. And likely because they got away with it, they're going to try and force into a situation where they're not paying. And all of us know that many of our tenants who wouldn't want to pay their rent, they know the system as well as, or if not better than we do. And they're likely just trying to push the limit. So let's make sure that we've got forms like pre-authorized debit that we can just pull from their account without them even having the opportunity to make those choices. Talked about requiring deposits prior to tenants occupying our space, but that's good. Talk about preparing regular invoices. So if we've got supplementary, I know Elizabeth was talking about this, if we've got supplementary services like property maintenance services or a flooring company, construction company, what we want to do is we want to make sure that we are invoicing these things upfront in advance, or trying to get that transaction, that cash element of the transaction as close to the front end as possible versus delivering everything and collecting at the end. When we do that, we've got all our cash outflow going out front, and the benefit that we're conveying to our customer or to our tenant is going to be at the front end of the transaction. Once they've received the benefit, they're less likely and less motivated to pay us because they've already received everything. So let's continue to push the invoices up to the front of the transaction. Aggressively collect any outstanding receivables. I could say this 100 times, and I probably should. One of the strategies that we need to make sure we have in place is a collection process. So if we try and collect for the first 30 days and then it goes to a collections agency, whatever that looks like, we want to make sure that we have an active process in place so that we don't miss out on collecting any of this money. Sell gift cards. So this is also an opportunity, right? If we've got any auxiliary services inside either our investment properties or our business, getting cash up front for future services, whether it's, again, an upfront deposit or we're selling some sort of gift card or taking deposits in advance. That's going to help us get more cash up front with spending more of our cash at a later date. Really going to help the influx of cash flow. Obtaining working capital financing. So this is a good one. For many business owners or investors, again, when people come in and they talk about not having the cash in the bank account after they've seen how much they've earned in income. And one of the reasons is that people will go out and pay cash for vehicles, for tools, for equipment, and not think that that's really pulling all of the working capital outside of their business and utilizing all of their cash resources. So better than spending the cash out of your business, let's get debt financing related to this, right? Let's get the bank to pay for these things, for the vehicles, for the inventory, for any of the equipment. All of these third-party companies that we buy assets from will finance it for us. And if they won't, the bank will. The bank really loves to have something tangible that they can attach themselves to. But let's not spend all of our cash out of our business, put ourselves in a spot where all of a sudden we're going into the spiral and we're starting to have to transfer around because we used our cash resources. Let's use the banks. And yes, interest rates are slightly increasing right now and likely will over the period of the next couple of years. Nothing crazy, but it's still worth it to pay 3% to the bank and keep all of the cash that we have for many reasons, right? Like if we can keep that cash and it becomes the down payment for our next investment opportunity versus spending it on a vehicle, something that is not generating income for us, that's going to be a way better opportunity than to get that into the next investment, something that's earning income versus something that's just costing us money. So obtain working capital, look at whether or not it can be a term loan. And if we can get a line of credit in there, maybe, home equity line, looking at that, it's really inexpensive money to get access to. Looking at lines of credit on any of our investment properties. Let's just continue to make sure that we have the maximum available to us. Not saying that we have to utilize all of it, although we certainly could with the right investment opportunity. But we want to make sure that our safety net is as big as possible, because if something happens, I want to be able to jump on either an opportunity or be able to manage my cash resources in the best way possible. And I talked about this as well, liquidating old inventory or assets that are not being used. This is just an easy, low-hanging fruit for us to get access to cash and put it back into our business. And have a sale as well. Okay, the opposite side, right? So the first side was how do we get all this cash in? Now we want to look at how we stop the cash from leaving us, which is equally important, right? We want to focus on bringing it in, but also focus on slowing it down from leaving. When we combine those two factors, we can really have a positive impact on our cash flow and put great reserves back into our business, into our investments, and maybe even save enough to get the next investment opportunity off the ground. We talked about accounts payable. So this is, again, one of those things. I'm guilty of this too. I'm very guilty of this. When I get a bill in, I pay it right away. And has that put me in cash flow challenges in the past? Absolutely, right? We've paid things too quickly. We've then had a delay in receiving some of the funds coming in. Yes, it puts us in a difficult position in our business. Let's make a policy that if we can, we try and set terms with our vendors that we avoid paying for 30 days, right? If we can get that in place, that gives us an extra 30 days to bring all the cash in. And if we do it the right way, it may allow us to get 2 months worth of cash resources in before we have to pay 1 month out. So that should give us a really good surplus. Accounts payable management is one of those underrated elements of cash flow that if we can get this in place and we can defer some of those payments, we're going to be able to maximize our cash resources. Utilize credit cards. So even better, if we can defer payments to vendors for 30 days and then put it on credit card, right? We get the vendor to process this on day 30. We've now got 60 days. So now if we can still focus on the cash flow coming in, we might get 90 days of cash resources in before we have to pay the first month. Right? It's a really good opportunity to defer payments going out and maximize the opportunity of bringing cash in. And I don't endorse maxing out our credit cards and paying the 20% interest. That's not the way that we should be doing it. But I will tell you, we were talking about vacations to kick it off. Not being able to travel for 2 years, my whole family vacation is going right on credit card on points. And if we can utilize that, right, we can take advantage of that point system. We get free vacation, which saves us cash resources. Again, it gives us 30 days interest free, and make sure that you pay that before you hit the 30-day mark. Avoid lump sum payments and prepaid expenses. Extend payments over a period of time. So obviously this goes back to some of the payable management. If we can avoid having to give deposits up front for work, right? It's the exact opposite of what we're trying to do. We're trying to get all the money up front, and then we're trying to not give any of the money up front. Obviously, it's not going to always be the optimal situation. We're going to have to pay some prepaids and maybe some shorter term payments because other vendors are as smart as we are. They're trying to bring the cash in as well. So what we want to try and do is put this and extend it out as long as we possibly can. Finance asset purchases, do not pay cash. I know I focused on this a little bit on the cash inside, but let's make sure that if we can finance these assets over a period of time with the bank's money, that we're going to do that. Now, here's the reason, right? If I think of, let's think of a construction company, because we can all relate to that one way or another, that I've got a construction company and I need to buy another vehicle because I need to put another crew on the road. Well, if I buy that vehicle with cash out of my business, that's going to be a really big outflow. But what is the intention of this vehicle anyway? It's to get that other crew on the road so that they can start generating income and profit to the bottom line of the business. So if I'm doing that, and I know that by adding that vehicle, it's going to continue to be a positive cash inflow, why wouldn't I match my outflow, my loan payments, to this income and let this vehicle actually be a positive cash flow the whole way through? Instead of being a big drain on cash resources right now, do not make that check or that one-time payment just because your business can afford it. Don't do it, right? Save that cash, put it in an investment, get 6 to 10% return on an investment there. Even if it's 4 or 5%, you're still ahead of the game. Plus, you have the power of access to cash, which is going to be the most important element. Set up regular owner payments, avoid making large cash withdrawals. So this is going to be something that we see inside our business often when cash resources, let me take a step back. If you introduce all of these elements and all of a sudden you take in 5, 6, 7 figures of cash inside your business, please don't go pull it all out after we've done all this work and put it in your pocket. Right? Yes, it's going to be your business's assets, but this is just managing the cash, right? We want to manage it so that it's not going out. So let's not start pulling lump sum payments out. Let's get ready for regular and frequent payments that you need to support your lifestyle. So for example, one of the great perks for being a business owner, if you own investment property inside a corporation, we can actually flow that investment income out to you as a shareholder, which is great. If you take $42,000 to $45,000 out per year as dividend income, your personal tax rate is as close to zero as we can possibly get. It's very, very slim to none. We pull that out. And let's call it 52,000 because it's just getting closer to a round number for me. So $1,000 a week that we could live off of, that could be a dividend payment where we pay minimal tax. Make that payment to yourself every single week, $1,000, $1,000, $1,000, knowing that the company can support it. And let's get used to that little bit of routine. Now, not saying that at some point, if cash resources continue to rise inside the company, that we can't take a lump sum amount if we need it. That's totally fine. But being able to have these consistent, regular outflows is going to help manage and smooth the cash resources of your business as well. Let's make it frequent. I love weekly. Our company has payroll weekly, which is great. If it was bi-weekly, I would likely have the same thing. I set all my bill payments up weekly as well. I pay my credit card weekly. I pay my mortgages, my cars, all weekly, right? I set my cash inflow up to match my cash outflow. And I avoid, not saying I always do, but I try and avoid ongoing large outflows because it really messes with the cash flow of the business. Working capital, again, if we're able to set up working capital to help support maybe some of those non-financeable items, such as inventory and even accounts receivable, just getting access to a working capital line of credit. This is something that I would always proactively look to do, right? Even if you don't need the cash, continue to work with the bank or any lender to make sure that you've got that working capital and that safety net. Because if we do and we never need to use it, great. I've got one client right now. He's got an $800,000 line of credit. He's never had to use it, but he's fighting with the bank for $1 million. And I'm like, why are we fighting so hard? And he's like, because I just want to have access to it. I'll probably never use it. But doesn't it give me a whole lot of power if I have an investment opportunity that I can go all in on with a cash down payment of $1 million? I know I'm going to get financed, or that $1 million buys that investment. And he's totally right. It gives you power and the ability to close a deal really quickly. Refinance debt obligations over longer periods of time. This is one area where I see a lot of people trying to accelerate payments, going, okay, I want to pay for this property over 10 years. I want to accelerate it. And you're just putting so much strain on that investment and on your business and whatever it is, right? Even paying your mortgage down that fast. It just requires you to get more cash personally to pay that mortgage down faster. What's the race for, right? If I can accumulate wealth and equity on an asset side at a faster pace, then I can decrease my liabilities. My net worth is going to continue to skyrocket. I don't want to continue to pull so much money out of my company that I'm paying high levels of tax. I don't want to pull so much money out of my business so that I can invest in another 7 to 10% return. Those are the areas that I want to focus on. As I see this with new doctors all the time, they come in, they've got, hundreds of thousands of dollars of student debt, and they're so focused on getting rid of the debt as opposed to accumulating assets. If we just accumulate the assets and we pay the debt down over time, eventually we're going to have substantial net worth. And if they just put that money away quicker versus paying down the debt, they're going to have more access to power, control, influence related to money, right? It just gives that increased safety net. And if something were to happen, they're not going to be able to re-borrow the student debt, right? Just like your house. If something happens to you financially, and at that time you go back to the banks and say, well, I lost my job or my investment's really in a bad spot, they're going to go, why the hell would we give you money now? You just showed us all your cards and it's not very good, right? Whereas if we go when everything's going great, we get it set up, we don't focus on paying it down, we focus on building the assets. If we have the assets there, we can always pull that back. We have control over that situation. Look at dividends versus salary to eliminate excessive regular withholding tax payments. So this is, if you've got anybody who's on payroll, if you or your spouse are paying yourselves on payroll, every single month, we've got to make that source deduction payment for Canada Pension Plan and income tax withholdings. You know what's better than that? Not making them, right? I'd rather keep that cash inside my business for now, knowing that I'll maybe have to pay tax on that dividend income at tax time, but I can keep that cash inside my business right now. And that likely will add up to a pretty substantial sum of money that you can continue to have access to now, have that control and that power over your cash resources. And lastly, review fixed expenses to ensure there are no non-essential expenses going through. So when we think of cash outflow, we think of expenses, right? One of the things that we try and focus on with a lot of our clients is going through those fixed items, the insurance, the rent, the subscriptions, the dues and memberships, anything that is not strategic or future thinking. we need to look at it and say, does it make sense? Because I don't know about you guys, but I know I still have some membership fees that I pay for software that I don't even use. You know, it might be $100, might be $200 a month for a CRM solution that I'm not using. I need to get rid of that, right? That's $200 that we just need to cancel. So we want to be able to look at our fixed expenses, make sure that there's not anything that's wasteful in there and not strategic. If it's there and it's going to help us build more wealth in the future, great, right? Let's continue to focus on that. Let's invest in ourselves and future opportunity, but let's not be wasteful. Let's eliminate things that are just bringing us down. All right, so this is where I want to talk about a little bit of income tax. And I'm not going to jump into this too deep, but I just want to talk about a few things that I think you guys can all take advantage of or have reassurance on to know that you're doing the right thing. Before I start, I just want to bring this up because it makes me feel better about me. A quote from Albert Einstein, he says, "The hardest thing in the world to understand is income tax." And I go, well, that's great, because I understand it pretty well, Albert. So I feel really good about me. But it is a really challenging thing, and every single year it becomes more and more complicated. So you want to make sure that you work with someone who does have the knowledge and expertise to help support you in the right way. I had the opportunity to work for Tony Robbins for quite a few years. We were his Canadian partner in his global accounting advisors group, which was amazing. When I was working with Tony, we actually did a review for people who would attend his business mastery, and we found out that 92% of business owners were paying more tax than they legally were required to pay. That's a pretty shocking amount. So with that, right, make sure that you're working with somebody who knows how to save you tax money and knows how to capture your best interest and is being strategic and proactive, right? We don't want to waste tax money, because the reality is, when we look at the cost of paying too much tax, this is $5,000 a year over 10 years. If we look all the way to the bottom, you think, well, Bob, 5,000, I'm not an accountant, but 5,000 times 10 is 50. Why are you showing me 155,000? Well, if we look at the 5 to 7% return on investment that we could have on that $5,000 every year over a 10-year period, it's lost income and opportunity of $155,000. Right? Keep in mind that this is an easy fix. I put $5,000 on there because likely if you're paying yourself a salary, we could save you $5,000 by switching to a dividend strategy. So if that's the case and we can save you that money, I just saved you $155,000 over 10 years just by bringing that strategy up to you. So make sure you look at these different tactics and know how you can save even $5,000 a year. It can have a substantial impact on your net worth in the long run. Okay, just quickly on this. So different structures for investment properties. I know Elizabeth is really good at talking to you guys in the real estate investment world about how to structure your investments properly. If we can get to a corporate structure quickly, it's likely going to be a really good investment, not only to protect you, but to get you into a better tax planning opportunity, right? If all of us are, or I guess some of you will have jobs and investments are your real estate assets. If that's the case, you're already earning employment income at a higher rate. Let's look at making a corporate structure pay tax on that, or utilizing another entity and maybe income splitting with other family members by using a corporate structure. The corporate rate for small business income is 12%. And I know Elizabeth and I work together on making sure that investment properties can get recharacterized as small business income or active business income. If you want to know more about those strategies, definitely reach out to Elizabeth or myself. But knowing that we don't want to pay, if you're at the highest tax rate, which right now in Canada is close to 56%, that's on anything over $200,000. People who are at that tax bracket are the people investing in real estate, right? Those are the guys who are going out and investing in real estate. So you're already paying a tax rate at that level. Let's try and recharacterize it down and pay less tax money. There's lots of great opportunities for tax savings or tax deferral by using real estate income as well, like depreciation and reinvestment that's recharacterized as repairs and maintenance. Lots of strategic ways that we can keep your taxes down with investment property. You're already making and paying too much tax money. We don't want to continue to contribute to that. We can hold it as a sole proprietor, which just means that you own the property personally, or you can have a partner and do it. But again, it's worth at least having a discussion to talk about whether or not a corporate structure would benefit you. Because again, if we can save you $5,000 a year, $155,000 over a 10-year period, it's going to be substantially impacting on your net worth in the long run. Okay, one of the questions I get at tax time every single year is, Bob, what can I spend money on in order to save tax money? And I usually say, me. Spend it on me. If you really want to get some tax savings, sure, why not? You know, we can come up with a plan for sure. But somewhat joking, right? Like somewhat joking, we probably are a really good area to spend your money if we can save you future money. The reality is though, guys, we do not want to spend money just to get a tax break. So if we think of this, right? I'm just wondering what I put down here. Okay, this is it. This is the description of it. If you are spending $100 and on that $100, you can save that small business tax, that's $12, right? Now you are out essentially $88 of that 100. You save the 12, you're out 100. What's better than that is to keep the 100 and pay the 12. You now have 88, right? Tax is not the worst thing in the world. And if we're going to spend something, right, spend it on me, spend it on Elizabeth, spend it on advertising, marketing, something that's going to make you more money in the future, because that's what this is all about. Let's build your net worth, right? And unfortunately, at some point, we will have to pay tax on that growth, but I would rather continue to grow. And I would rather retain the asset as much as possible, even if it comes with paying a little bit of extra tax. Now, that doesn't mean that we're not going to do everything we possibly can to keep your tax rate as low as possible. I'm just saying, don't go out and excessively spend for no reason. You're going to be worse off than you would be if you paid that 12% tax. Okay, so this is where we talk about maybe some strategies that you could put in place. What do you need to spend money on in the next 6 months for your business, for your investment? Let's now look at spending that maybe before the end of your tax year. If you're an individual, we're on the calendar year. If you know you have to buy or replace something, let's say you're replacing windows in one of your buildings, right? Let's spend that money in December, right? Replacement of windows are not improving the value and the long-term structure of the business. We can expense that as repairs and maintenance. Let's do that in December. It gives us a huge deduction and it's a massive write-off inside your business versus doing it in January. If we do it in January, we're still going to have to pay last year's tax bill. And now we're out tax and the cash for the windows. So it's about strategic timing. If we need to do it, let's be strategic about it and pull it into the most current tax year so we get that immediate savings. Bonuses. Bonuses are an interesting concept. If we have, even if you own the property personally, and if we have kids, for example, we can actually claim a bonus, even if we don't pay it out for the next 6 months. We have 180 days to pay a bonus out in order to get a deduction now. So if you're thinking of that, you're going through and doing your taxes right now, and you go, man, oh man, Bob, I owe $10,000 right now. Okay, well, let's give a $20,000 bonus, right? If we give a $20,000 bonus now, you can pay it out in June, no big deal. We can claim that bonus right now in your 2021 year and pay the taxes at a later date. So there are opportunities there. Bonus payroll is an opportunity that we can claim the expense now and deal with the payment later. Income splitting, I love this. Those kids deserve to get paid. There's an opportunity here, guys. My kids are 13 and 11. My daughter will come in, she's 11, and she'll come in and do some filing work for me. She's also probably much better on social media than I ever would be. I was actually talking to her about TikTok. I do not have an active TikTok, but she is like, let me run this for you, Dad. I'm a little nervous because she's 11, but likely, you know, from a consult standpoint, she can tell me how all of The metrics are going to work because any of the videos she wants to get as many people to see them as possible, right? That's what we want with investment properties, with our businesses. So I can pay her up to $12,000 a year without her paying any tax on that, right? If she has no other income, every individual in Canada's got a $12,000, approximately $12,000 exemption. She gets that as income. Because she's under 18, no Canada pension plan contributions, straight deduction from the investment income or from our business. So what a great opportunity to implement that. There is, one consideration, it has to be appropriate pay for what we're getting back. But in this example, is it reasonable to say that my daughter could be giving me strategic TikTok advice for $12,000 a year? 100%. And I would take that all the way to Canada Revenue Agency and see if they can give me the same sort of advice at their rates. And I bet you they can. So those kids deserve to get paid. Let's get that deduction. And anything else, right? So anything inside our investments or inside our businesses, the general rule of thumb here is anything that we spend money on that is going to incur future revenue or future income for us is deductible, right? Thinking of, maybe even a few others. If we have employees, for example, you can give an employee a bonus for up to, not a bonus, a gift up to $500 as a gift, non-taxable to them, fully deductible inside the business. Don't give them cash. Don't give them gift cards. Buy them something they want. Full deduction, non-taxable to the business or to the employee. So looking at different strategic initiatives like that. Do we have a holiday celebration? If we have a holiday celebration or a summer party or anything like that, and everyone who works for us is invited, maybe that's just you and your spouse. If we have that, we can deduct 100% of that meal and entertainment. So consider that next time, instead of it being 50% like regular meals, if everyone who works for you is able to be invited and to participate, then you can claim 100% of that. Okay, I know I'm getting close on time here, and I know we want to get some questions, but I need to get through this because this is where we start to explode our net worth and our business performance. 3 things that I want to talk about. Very first one is know where you're heading. Start with the end in mind. If you don't know where you're headed, any road will get you there. Guys, we need to know if I'm driving from here to LA, I need to know the map that's going to get me there. And when I say here, I'm just outside Toronto. So if I go from Toronto to LA, I need a map, I need a GPS, because if I just start turning left and right because I feel like I'm heading in the right direction, what's the likelihood I'm going to get lost? We don't want to get lost on our journey to wealth accumulation and investment success. Know where you're heading. And if you don't, any road will lead you there. We want the specific road that's going to get us the greatest outcome. Second, dream big. This is something I think I just said at the beginning of the webinar that I'm going to meet with Grant Cardone. So Grant Cardone's a big investment property guy as well. So I'm going to have the pleasure to do some business with him this week, which is really exciting. One of the things that you should probably read is his 10X book. If you haven't read it, it's all talking about dreaming big and thinking big. And one of the things that he says is, I would rather think big and fall short than think short and meet that criteria. And one example that I'll throw out is saying, I want to make $1 million this year. And I want to set myself up. I want to know the pathway. I want to know the road that's going to get me there. But if I fall short and I make $700,000 this year, I'd much rather fall short at 700 than say, you know what, my goal is just going to be that $300,000. That's where I feel really comfortable in. Even when you fail, you're failing forward by more than double in that circumstance. So now a lot of business coaches, which I am definitely a business coach, a lot of business coaches talk about that sense of failure and hitting that finish line and always feeling like you haven't accomplished something if you always fall short of your goals. And I completely agree with that. So the way that we combine the two of them is we always reflect on where we came from. So what you want to do is you always want to look, at your financials and say, I want to know where I am this year compared to where I was before. If I can see progress, even if I'm falling short, I still feel that sense of growth and success, even if I'm failing in hitting my absolute goal. But the ultimate area that Grant would talk about is, who cares if you fail, but you're continuing to make progress towards achieving great things. So think big, set your goals, and take action. And the last piece I want to give you, and I'll go through this quickly, there really are only 4 ways to grow your business or your investments. Increase the number of clients or tenants you serve, right? That's getting the increasing number of units. If you want to grow your investments and your net worth and your income, you need more tenants, more clients. This is really related to lead gen or investment in additional properties. 2, increase the frequency of client purchases. So you may say, oh, well, Bob, it's a rental property that I'm specifically dealing with. I can't increase it more than once a month. That's just the reality of the situation. Like Elizabeth said to kick this off, if you can find a supplementary service, property maintenance, cleaning, right? Whatever it is, window washing, meal prep, whatever it is, find a way. Now that you've got these clients, you know where they are, you know where they live. Why not find another way to generate revenue from them? So looking at increasing the frequency of your client purchases. This is also, if you do have a business, this is where referrals come in. It's super great to have referrals come in and support your business growth because you've done a good job. Just saying, hey, is there anybody that's just like you who I could help have a great impact on, like I have with you? So let's find out how we get those referrals. And the last, or this is not the last one, it's the third one, is increase pricing. So if we have $500 a month rent, I know we're going to have restrictions on how much we can increase our rent, especially if we're looking at any sort of moderate housing programs. But even if we increase 5%, that's going to continue to increase our income, increase our bottom line, because when we increase our rent or our service fees or our income, whenever we do that, we're not changing the expenses related to delivering on that, right? We might have inflation that's happening, but if we can continue to increase our pricing and the income that we're generating per customer, we're going to be able to generate more profit from our investments and from our business. And the last one, this is like the secret sauce of the 4 ways to grow your business: retention. It's great, if you think of a business and all lead generation and more investments, you think of like a bucket full of water, a hose going into the bucket and it's overflowing. That's great. But if there's holes all in the bucket, you're never going to be able to fill that bucket up. Retention is filling those holes, making sure that you're doing client satisfaction surveys, making sure that you're meeting the needs of your tenants. That's going to help you continue to maximize the value of your wealth. Okay, in summary, cash is power. Let's manage our cash resources in the best way. Don't pay too much tax. If you're ready to grow, start with the end in mind. Know what road you need to take to get the greatest level of success. Think big, right? Think big and pursue your dreams. Don't let anybody tell you that you should be more conservative if you are really passionate about doing incredible things. And remember the 4 ways to grow. I want to give you a free gift. I wrote a book called The Wealthy Entrepreneur. It's got strategies in there that will relate to you, whether you have a business or you have investment properties. There's a major chapter on cash flow. So if you want more detail related to that, text money to 705-710-9540. My bots will have that over to you momentarily, but certainly happy to answer any questions that we have now, Elizabeth.
Fantastic. Thank you so much, Bob. I was furiously taking notes because as much interaction as we have and as many conversations as we have, there's still some great tidbits here. I really appreciate it. So a couple of things. So I want to be mindful of time. I know there's some people who will need to get back for lunch. So I think what I'd like to do is we'll kind of wrap up the webinar and then we'll jump and do the Q&As, just so that if people need to leave, that they have the information they need. Okay, so there we go. Okay. Are you able to see the chat, Bob? Have you been kind of following along?
I have not been following the chat.
Okay,
I do have the Q&A open, but
perfect.
yeah,
Okay,
yeah.
so we'll do the Q&A in just a second. First, what I want to do is thank everybody so much for sharing their lunch hour with us and giving us the opportunity to provide you with some amazing food for thought. My brain is already whirling about the changes that I want to make based on the information that you provided. Just let me hop on here to the PowerPoint. So obviously Bob has shared his contact information. I would imagine everybody here pretty much knows how to find me. My next webinar is Monday, April 11th. And we have Victor Manas and we have Phil Reimer from Dentons. And what we're going to be talking about are actually partnerships for growth. And I'm not talking about like the traditional joint venture partnerships. I'm talking about what happens next. I'm talking about when you buy a big building, when you are looking at getting into land development, when you're looking at doing some of the limited partnerships, the equity partnerships, all that super cool stuff. So that's Monday, April 11th at 7 p.m. with Victor Manas and Phil. Phil is a lawyer from Dentons, which is probably one of the foremost firms in Canada for putting together these interesting, unique, and large-scale partnership structures. And then Victor, of course, is a developer and experienced housing provider in Canada and the US as well. So he's going to be sharing kind of how he puts deals together and then how he matches that up with the various structures that Phil's going to kind of walk us through. So hoping you can join us on Monday, April the 11th. Thank you so much, everyone, for attending today. And for those people, there's 3 great questions. So the first one is from Scott, and he's saying, how do you account for seasonality when you're managing cash flow? And I happen to know Scott, so I know that Airbnb in particular, I know there's a lot of people who are challenged with, you know, in the winter months, my revenue drops substantially. How do I balance that out? Like, would you take, say, the next year's worth of expenses and leave it in a bank account for, you know, to get you through the tough times?
Yeah, seasonality is a challenge, right? But what does it mean? It means that we have an opportunity to plan it out properly, right? When we know that seasonality is a challenge, what we need to know is what the expenses are that are going to be the outflows during those periods, because we're going to have enough surplus cash in there in order to cover those expenses. So that's when cash flow planning becomes really, really important. The other area that I would focus on, Scott, would be on that working capital, right? Is there a way to get a line of credit? Can we use some of the equity in a property? Can we get an operating line inside our business that's going to give us a bit of safety net to get through those sorts of times? There's a really great, and I don't know, Scott, if it's just purely an investment or a business, but I'll give you guys all a resource that has been super helpful over the last couple of years. So BDC Canada has got a $100,000 loan application. And yes, the rates are a little bit higher. I think they're maybe around 5%, but you can actually go online and get access to up to $100,000 if you've had an existing business and you need a little bit of a cash injection. So go through that. It's online. It's super easy. You likely get $100,000 in your bank account within a week. So it is that timely. So use something like that. Yes, we have to, know that we're going to incur 5% interest on those payments. We may even be able to schedule it with BDC that loan payments don't happen during those times of the year, because they're pretty good at being able to be flexible with that. I would also talk to your banks and say, is there a way that we can structure these loan payments for 8 months of the year and not 12, so that I'm not having cash outflow in the times that I'm shut down? So for sure, an opportunity to plan this out and gain more power with resources like working capital or loan proceeds.
Love that. Love that. Okay, fantastic. Brad said, is there an advantage to leasing a vehicle versus owning a vehicle and financing it over a time?
Yeah, Brad, this is one of those questions that I get all the time too. And unfortunately, it's going to be, it depends, right? But I can give you why it depends so that you can make your own answer. So 2 things that we need to consider. 1, are you substantially using that vehicle for business purposes? If you're not using it for more than 90% business use, I would own it or finance it personally, right? So we need to understand, is this going to be a business asset or is it going to be a personal asset? I'll say that again. If you have a vehicle and you're using it for more than 90% business use, then you can buy it in a business. If you're using it for less than that, I would own it personally. Why? Because if you get a taxable benefit based on that vehicle value, you're going to pay more tax on that than you're going to save. So let's not get ourselves into that situation. I actually like it. And the other thing would be, even if it is 90%, so if there's real estate agents in here who are doing this and you're traveling a lot for business purposes, you get 60 cents a kilometer mileage reimbursement. So if you're doing more than your share of kilometers, and 60 cents per kilometer reimbursement is more than your loan payments and your gas charges, then I would for sure own it personally. The company's going to get the full deduction, or the property is going to get the full deduction, and you're going to get reimbursed for that. So you might be better off owning it personally all the way around. If it's a fleet of trucks, like pickup trucks that are work trucks, for sure, put them in the business. So that answers question one that you didn't even ask, but I answered it anyway. The second is on the lease versus finance. So here's how that works. I would always look at cash flow. So if leases are going to be less of a cash burden for you, then maybe that's a way to go if that sort of cash differential is important. From a tax perspective, your lease on a vehicle is maxed out at $800 per month, which is okay. If you're getting above that 800, extend your lease payment terms out to maybe 6 or 7 years, it'll drop that payment down. That $800 is going to be a really good benchmark for you. The other option is on the financing side. We don't get the deduction for the payment, but we get to depreciate that vehicle. Now, if it's a passenger vehicle, we've got a limitation of that $30,000. So it might make more sense to match your payments on a lease for the business than buying it and depreciating it. So when we depreciate, you're going to get a higher tax deduction in the first couple of years, but it's going to continue to drop. So for me, I like leases. It matches my payments to my expense so that my cash outflow is matching what my deduction is going to be. But for sure, I also like owning it personally and charging that mileage back to the business.
I think it depends what kind of vehicle and what kind of usage too. Like if we're talking about a truck for construction and job sites, like the damage they take quite often and the kilometers you do makes leasing not worth it. So I think that fully plays in with your it depends. There's a couple more questions that have come in. So what I'd like to encourage people to do is to actually connect with Bob directly. My Moguls Mastermind, I'm excited to get back to. What I'd like to do, Bob, is just finish with one last question here. Trevor asked, does your company offer full services nationwide? Can you help investors across Canada or just in Ontario?
We can help investors across Canada and in the United States. So we fully serve North America, which is very exciting.
That's amazing. Thank you so much, Bob. Thank you for joining us, everyone. Have an awesome start to your week. What is better than focusing on maximizing our cash flow as we're heading into spring? All the best, guys. Hope I see you on April 11th. Thanks again, Bob. You're such a wealth of info. It's such a pleasure to have you.
My pleasure. Have a great day, guys.
Take care, guys. All the best. Happy investing.